Okay, let's talk about something that can feel, well, super intimidating. The Indian tax system. It honestly feels like a giant, complicated maze sometimes, doesn't it? But what if I told you there's a much simpler way to look at it? Let's see if we can figure it out.
I mean, it's a totally fair question. You're not alone in thinking this. The second you open any official tax document, you're just hit with this wall of text and jargon.
I mean, you get hit with words like amortization, amalgamation, and demerger. It's so dense, it's incredibly specific. And let's be real, it's designed to be read by lawyers, not regular people. Or how about this one? What in the world is an arm's length price? And how is that different from a specified domestic transaction? Honestly, it's enough to make you just want to close the tab before you even start.
But here's the thing. We don't need a law degree to get the big picture. The secret is that we can understand the absolute core of the Indian tax system just by following our money. We just have to track it through three things we all do: earning it, spending it, and growing it. So let's start with the one we all know, the most common way we run into the tax system: earning a salary. This is our first encounter with what's called a direct tax, specifically income tax. Right off the bat, you're given a choice between two ways to get taxed: the old regime and the new regime. Think of it like this. The old regime is great if you have a lot of specific investments and expenses, because you can use them as deductions to lower the amount income you pay tax on. The new regime, on the other hand, just gives you lower tax rates from the get-go, but the trade-off is you can't claim most of those deductions. Now, looking at these tax brackets, this is where a huge myth comes from. A lot of people think that if your income pushes you into, say, the 10% bracket, that you suddenly pay 10% on your entire salary. But nope. That's not how it works at all. The key word here is marginal. The system uses marginal taxing, which just means you pay the tax rate for each bracket only on the chunk of money that falls within that bracket. So for that 7 lakh salary, the first 2.5 lakh is taxed at 0%. The next bit is taxed at 5%, and only the final amount gets taxed at 10%. It means your actual tax rate is always lower than the highest bracket you're in. All right, so you've earned some money. What's next? You spend it, of course. And every time you buy something, whether it's a coffee, a new phone, or a hotel room, yep, you're paying tax then too. This is what we call an indirect tax. It's called that for a pretty simple reason. You don't pay it directly to the government. Instead, it's just bundled right into the price tag. The most common one you see everywhere is GST, the goods and services tax. And what this chart shows us is a really simple principle behind GST. Luxury stuff gets taxed more. A budget hotel stay might have a 12% GST, but that 5-star luxury hotel, that's getting hit with a 28% rate. The same logic applies to pretty much everything, including cars. And just when you thought that was it, you might spot an extra little charge on some items called a cess. You can think of it as a tax on top of a tax. It's usually collected for a really specific government project, or it's added to what are sometimes called sin goods, or super luxury items like tobacco or private jets. Okay, so you've earned your money, you've spent some of it. Let's move to the third and final activity, putting your money to work for you by investing it. Because when those investments turn a profit, the government takes a little piece of that too. And that tax has a name: capital gains tax. It's a tax on the profit you make when you sell something called a capital asset. That's just the official term for things like your stocks, mutual funds, gold, or even a piece of property. Now, with capital gains, the government really cares about how long you held onto that asset. If you sell a stock in less than a year, it's a short-term capital gain. If you hold it for longer, it's a long-term capital gain. The tax rates are different for each, and that's on purpose. It's the government's way of encouraging people to invest for the long haul, not just for quick trades. So, for example, if you sell a stock you've held for less than a year, that profit is usually taxed at a flat rate of 15%. That's the short-term capital gains tax. It's a really important number to remember if you're an active trader. Earning, spending, growing. You see? When we break it down like that, the core ideas are actually pretty simple. Which brings us all the way back to our very first question. If the concepts are this straightforward, Why on earth is the official rulebook so mind-numbingly complicated?
Well, just look at how the law defines something as basic as income. It goes on, for pages, listing out every single possibility: profits, dividends, contributions, even the value of any perquisite, which is just a fancy word for a job perk. Why do they have to be so incredibly specific?
Because in the world of law, every single word matters. So all that complexity, it's not actually there to confuse you. You could say it's not a bug, it's a feature. The goal is to define every possible kind of income, every situation, to leave absolutely zero ambiguity or loopholes. It has to be that precise to make sure the system is fair and that everyone pays their share.
So, after all that, what's the big picture? What's the main takeaway? We've managed to cut right through all that confusing jargon to find the 3 simple activities that really define our relationship with taxes.
It all comes down to this simple flow. First, you earn money, and you pay income tax. Then you spend it, and you pay indirect taxes like GST. And finally, you grow it, and you pay capital gains tax. If you can remember that simple journey, earn, spend, grow, you've basically cracked the code.
Which leaves us with one last big thought. It's really easy to look at taxes as this personal chore, this burden we all have to deal with. But that money is what pays for the roads we drive on, the public schools, the hospitals, all the services that make a society function. So is tax just a burden, or is it maybe just the price we pay to live in a civilization? Thanks for joining us on The Explainer.